Hello, everybody, and good morning. Welcome to the Top Producer Show. So our mission is to educate, equip, and train servant leaders. Our vision is to create financially independent achievers, and our purpose is to help people grow. And right now we're going over The Unfair Advantage by Robert Kiyosaki. And before we jump into that next chapter, which is risk, we are going to invite some people onto here. So while I am doing this, anybody who's jumping on, I would like for everybody to put in the comments where you guys are plugging in from. It's always fun to see where, who's all plugging in and how many people from all over are getting on this. It's always fun to see, so if you could type in where you're from. Alrighty.
Andrew, what's happening? So guys, today we're on chapter 4 of The Unfair Advantage, which is risk. And we have to do this one in 2 parts because Robert Kiyosaki likes to have chapters that are like 900 pages. Chance Brown, how are you? So risk, what is a good investment? And basically he says there's really no good answer for that. If you don't know anything about anything, probably not a good idea to invest at all, unfortunately. And this is long. Okay, so what is a good investment? And he said, answer only things that you are willing to learn about. You know, that's what the answer is. The answer is only things that you're willing to learn about. Only things that you're willing to study. What is extreme risk? Extreme risk is when you say, oh my gosh, I'd never take a risk. Or I'd rather play it safe. And he said, you know, this comes into the words oxymoron, words that contradict each other, like jumbo shrimp or government service, honest politician, civil war, holy war. You know, they just don't make sense, but they're complete opposites. And what did I do here? Okay, I'm back. He said, here's some money oxymorons. Job security. He goes, they're in direct opposition of each other because you're not in control. You can be let go at any point. Saving money, and the reason he says saving money is an oxymoron is he goes, what he's talking about is saving money inside of a savings account, not building up money to go do something, which is different. But saving money, thinking saving for the long term, is an oxymoron because money is being devalued. Save, a safe investment, you know, a safe investment. Well, the definition of an investment is risk. Fair share. I got my fair share. Usually not. Mutual funds. You know, if you read Tony Robbins' book, he goes over the statistics of how often mutual funds actually perform at higher peaks. He goes, the reality is after you take out the fees, which is what most people don't do in their advertising, is they disguise the fact of what's actually being made. Diversified portfolio, debt-free, job security. So why does he have job security? Oh, job security is the next subject because he kind of goes into depth here. So not only are low wage jobs flowing overseas, but technology is eliminating high pay jobs. And the bigger the world economy, what happens is the bigger the world economy, right now, most people in the world make less than Americans, and people don't actually know that. Most people in the world make less than Americans. So when you merge everything together and you add a couple billion people, it's going to lower what we make. It's going to lower the average. And some people, economically don't understand how that works. So jobs will continue to be lost overseas, American workers are paid 40 times more than the lowest wage worker in the world. 40 times more. So we start merging with countries that have, multi-million, billions of people. What do you think is going to happen to the overall wage? It's going to average out based on the number of people. Take 350 million people, which is the United States, which isn't that large in the idea that there's 7 billion people in the world, and you start merging that together, it is definitely going to lower the average person's income. This means jobs are not coming back. With breakthroughs in technology, it's the owners of the businesses that are going to win. I just recently, and this has nothing to do with the book, but I recently was online and I learned that Japan has made a robot that can cook a meal, 200 meals, with a 99% accuracy. So it means it only misses 2 meals that are off a little bit, but they can cook that many meals. The robot's like $3,000. And you think about how many businesses that if you could put a robot in that would cook a meal exactly the same every single time with very little flaw. Doesn't require what? Doesn't require retirement, doesn't require Social Security, doesn't require a health insurance plan, doesn't require a vaccine. I mean, it's pretty obvious that would, work out really well in the business owner. Now, how will that work out for everybody else? It means jobs aren't coming back. Those with job security will basically pay more and pay more in taxes. They'll pay more overall. With growing national debt, governments will be raising taxes. The more debt, the more taxes you have to mitigate the debt, unfortunately. So basically, what Robert Kiyosaki says is they're basically playing games with money. To keep jobs and people employed. Why did it jump like that? Okay, sorry, my screen's jumping around. This means jobs aren't coming back, growing national debt. So playing games with money, by keeping their money weak through exchange rates, or just printing more of it, a country exports are cheaper. And if a country's exports are cheaper, it means that the country's making money. So there's really a war going on with money. China and the U.S. are at war with money. The U.S. basically wants China to raise the value of their money so we can export more stuff to them and import less. Because obviously if you're exporting stuff, you're making money. If you're importing stuff, you're paying for stuff, right? In retaliation, the U.S. keeps devaluating the dollar and China devaluates their currency, the yen. So it is a game. I mean, they're both going like this, and it just, as we print more, it lowers and lowers and lowers. Who's going to get the best deal? It's not going to work out well in the end. Weaker currencies mean inflation at home. So weaker currency meaning the more money we print, the more inflation happens, the more taxes happen to pay for all this. The country can export more, but the person involved doesn't make as much. So a little financial history. The worst disasters in modern history came to power during times of financial crisis. Hitler, Mao Zedong, Lenin, Milosevic of Yugoslavia, all basically were born out of economic hardship. And basically, out of that economic hardship, they had to blame somebody and point the finger at somebody. So always be careful when everybody's like, it's got to be all their fault. So Hitler and President Franklin Delano Roosevelt came to power in the same year, 1933. FDR's administration basically created many of the financial institutions that cause the financial challenges today in the United States. Social Security was created at that point. And Social Security is really, like, when you read about that, how they created it, they basically talked all of the lower class workers into saying, hey, these big companies don't have your best interest. You should pay into this, and then we'll take care of you. By the way, anytime the government says, we'll take care of you, you're fucked. I mean, basically, you're screwed. Like, you do not want the government's help in most cases. You want them to create a free market as much as possible, and then let things work out. But anytime the government gets involved, it doesn't work out well because of how the government spends money. They're getting money that they don't own, meaning it doesn't come from them, and you have people making decisions about it who don't contribute into that pool, and then they're making the decisions for everybody. So they talked basically the poor and the middle class into voting for Social Security, and basically it was just a way to generate a guaranteed revenue. FDIC, Federally Deposited Insured Corporation, because prior to that, during the bank run, banks were able to borrow. Remember, we were talking about fractionalization. Banks were able to borrow money, bring it into the bank. So you create a debt for $100,000. The bank can then borrow money from the Fed at a fraction of 1 to 10. So 100,000 to $1 million. They get $1 million in the bank. And these crazy idiots were actually loaning out every single dollar that they got in, and then some, which helped create, the problem. So now FDIC says your money's federally insured up to $200,000. The government will print more if needed, basically. So FDR also took. So they created FHA, Federal Housing Authority. I don't think they created it. That was an independent, but it's government backed or something. FDR is also took the country off the gold standard. I didn't know that. So he took the country off the gold standard, which created hyperinflation. Many people believe it was World War II that brought us back. The war did help, but it was actually a balance of payments, and it was the Bretton Woods Agreement of 1944 that restored the gold standard and basically increased the power of the dollar and the U.S. In 1971, Nixon broke the Bretton Woods Agreement with the world we have today and the crisis we have today facing basically a collapse. In 1971, prosperity was created through debt and inflation instead of through actual money. It's really wild. With the discipline of gold, the Federal Reserve banks embarked upon a process known as systematic inflation. This system survives as long as the rest of the world goes along with the cash heist. If the world wakes up to the fact that it's phony money, it's a fantasy, it's not going on, the whole thing collapses. If the dollar, and this is Robert Kiyosaki saying this, he said if the dollar goes, the U.S. goes. So then we get into saving money. That's the next subject. He says, why save money if our governments are weakening the purchase power of the money? He's like, so just holding on to money in an account indefinitely is not smart. In 1971, money stopped being money. It's now fake printed dollars. It's in good faith is what it's called. In good faith. In good faith that this will all work out. To create money, the U.S. Treasury issues T-bonds, T-bills, and T-notes, which is simply an IOU to the taxpayer of the United States. So they create the money and then we get to foot the bill. So let's say the Treasury decides to issue a $10 million T-bill. Private investors, banks, countries such as China, Japan, England can buy up these T-bills, which is debt and an IOU. But guess who pays it off? The taxpayer. So many people like U.S. debt because our debt is basically considered some of the safest debt in the world, especially since we can print more money to pay it off. And that brings us to quantitative easing. If you ever hear quantitative easing, well, there's quantitative easing going on. Quantitative easing is basically printing money. That's what quantitative easing is. It says if no one buys the debt, the Fed steps in and writes a check to buy the bond. So if basically as we devalue our money and our credit rating in the world goes down, by the way, our credit rating has dropped in the world. When our credit rating goes down, meaning we're irresponsible and we lie and we steal and cheat like everybody else, what happens then is the Fed has to come in and write a check. Nobody will buy the T-bond. So we basically create money out of thin air. Which is the reason they call it quantitative easing, because quantitative easing sounds a whole lot more mathematical and accounting-wise than, hey, we just fixed the problem by printing this. If you ever wrote a check without money in your bank account, you'd go to jail, but the Fed does it all the time because the Fed gets the money from the World Bank, so the Fed can make up any amount of money. And the Fed is not, it's kind of funny, the Federal Reserve Bank is not federal. It has no reserves, and it's not a bank. But it is a government play on words to trick stupid people into believing what they want you to believe, that the Fed is doing fine and the Fed has our money. The Fed actually doesn't. The Fed is a private corporation. And the Fed cannot be audited. This is another cool thing. The Fed cannot be audited by the U.S. or anybody else. They actually signed off, when it was created, when the Fed was created in like Christmas Eve of like 1913. A group of very, very wealthy professionals got together, very wealthy business people got together and wrote that into law and had just enough senators there to pass the bill. It was horseshit. So, definition. T-bills, T-notes, and T-bonds are issued by the U.S. Treasury. The difference between these is the length of maturity. A T-bill is less than 1 year old. A note is 2, 3, 5, or 10 years old. And T-bonds are issued in terms of 10 years or more. So, definition, or some more definitions. Inflation versus hyperinflation. It says inflation simply means you're printing more money and devaluating the money, so the money you have buys less. So the money you have buys less. So $10 today buys, let's say, 2 of these. And if you have inflation, eventually $10 only buys 1 of these. That was a very simple way to put it. Hyperinflation is really interesting. Hyperinflation has nothing to do with money supply. It has to do with what people believe. So it can be having too much money. Like there are countries that went through hyperinflation and they printed so much money, people are like, well, obviously this has no value because Joe the bum or, Sally the person who isn't doing well has, a gazillion dollars. Zimbabwe had this problem. Zimbabwe's currency collapsed because they kept printing money and printing money and printing money and printing money, and eventually it wasn't worth anything. There's a great story of Brazil. This happened in Brazil where a guy showed up to the bank with a barrel, or not a barrel, but a wheelbarrow full of money. And it was left outside of a bank and somebody dumped the money out and stole the wheelbarrow. Why? Because the wheelbarrow was worth more. So hyperinflation has a little to do with money. It could be having too much. The basic principle is the money's not valued because nobody wants it. Nobody wants it. Whether you printed too much of it or you have too little of it, nobody wants it because they're like, that's not really, belief is basically gone. Faith is gone. The monetary collapses. So that's what we got for today. We're going to finish the second chapter on Monday. But what else?
That is it. So like Jeff said, we're going to finish the second part of this chapter on Monday. I can't believe it's Friday already. Like that went by very fast.
Very fast.
So I hope you guys like this book so far. There's a lot of information here that is explaining a lot of what's going on right now. So this is actually a really good book that we're going over because this is, and I always love Robert Kiyosaki stuff because he's always going to talk about things where I'm like, oh, I was never taught that. So I like his books because it's getting everybody the information that they need so that way they can better plan for things. Because the one thing about business is if you don't understand money and how all this stuff works, you're not going to be able to go very far. So it's a good thing that we're going through this book because I think it's actually going to help out a lot of people. And this is a book that I haven't read before until now. So this is a great thing that we're going over. Now, if you guys haven't yet, you want to go to the Top Producer Show Facebook group and you want to go, or the page, not the group, the page. You want to go to that page and join that page because each day we're going to be uploading our notes from each chapter. And also go follow us on YouTube. Each one of these videos is going to be uploaded to there. And that way, if you ever want to go back and rewatch these, you are more than welcome to do so. David, I guess we need to mine more.
Bitcoin.
Yeah. Alrighty. Well, we will see you guys on Monday and have a great weekend.